All right. Okay, so it's actually gone after 1 o'clock, so we'll make a start. Can you guys hear all right over here? I think that's a nod. Kind of hard to tell. You guys okay? You fine? You guys okay? Yep. So you guys okay? Okay, so we're in the section on the bank performance, bank management section, and so we'll briefly review just a few major points from last time before we progress on. One of the first things that we looked at in terms of the bank performance is there's two key measures. One, the return on the assets, and the other is the return on the equity. And these two things are quite distinctly different in terms of their size. And I showed this yesterday. This is for New Zealand banks as a whole. And in terms of return on assets, they earned about 1.4% on their assets. But the return on equity was about 18.6%. So this is in percent. And the main reason for that huge difference is that banks have very little equity, typically well under 10%, often sort of like 6 or 7%. And the balance of what they have in terms of the funds that they raise to do their business is debt of one form or another. And so although they have a very large balance sheet in terms of assets and liabilities and equity, if you look at the returns that they earn on that huge balance sheet, quite small, 1.4%. But when you look at the tiny amount of equity they have, you can work out from that they've got less than 10%, and so that tends to make the return on the equity look quite good. And this is one of the arguments that people make for keeping the capital low, as from a bank investor point of view is, the lower the capital ratio you have, the higher the return that you earn on that equity. And of course, hopefully, as a shareholder, that means a higher return to you. Then we went on to look at bank income statements, and we had some data from Australia, but I've also brought along some from the ANZ. Oh, hang on, that's their capital. Where's my other one? Here's their income. For something like the ANZ, which is a traditional bank, makes deposits, takes deposits and makes loans, the big place where they earn their money is in difference between interest income from their loans versus the interest expense, which is deposits, term deposits, money market securities, and bonds. And if you look at all the other income that they earn across here, this is largely, not always, but largely fees for service. And of course, in them they have a trading arm as well. But most of that is pretty small compared to the amount of money that they earn from their traditional banking business. And in the other slide that we had yesterday, what we saw is that the other banks, not the four big ones, but the other banks in Australia, they were the other way around. The amount of money they earned from their traditional banking business was relatively small to their other income, which is basically income from fees and services. Then we went on to talk a little about the dilemma that bank faces in terms of its profitability and solvency. And we drew this diagram here. So the basic problem for a bank is it's got to essentially manage three groups of people that are interested in its performance. One is its shareholders, the other is its depositors, and then, of course, the regulators. And the basic problem they face is they need liquidity to survive, but the stuff that has lowest liquidity gives the highest return, and as the rate of liquidity goes up, we get over to high liquidity stuff, you have the lowest returns. And of course, the safety follows the high return is the low safety, low return is high safety. And so balancing these requirements from shareholders who want lots of profit, that means more risk, less liquidity, safety from the depositor, which means less risk, more liquidity, lower return, and the regulators as well, is a job that the banks have to undertake on a daily basis, balancing all these requirements and hopefully not going too extreme in one direction or the other. And hopefully your banking business will survive for a long period of time doing that. And then we moved on to talking about bank solvency, and this is primarily around the bank capital that they hold. And we also discussed this earlier in the other section, the section on the regulation of financial institution, about what actually constitutes bank capital, how you measure it, and how you measure adequacy. But the basic point here is that the bank capital is there to absorb unexpected losses on your assets. That's its economic purpose. And then we talked a little bit about how we split that in the capital into two pieces. There's a Tier 1 and a Tier 2. And basically the difference in terms of what that means for you as a bank is that Tier 1 capital is basically stuff that you can write off losses against immediately without there's no restrictions on being able to write out losses against that Tier 1 capital. Whereas typically when you look at Tier 2 capital, although you could write off losses to that, often you can't do that immediately. If you say, I think we'll go back a couple of slides here. Some of the stuff like terms, oops, hang on, lost my little thing down here. Turn my pen on. Like debt, term supported debt or these convertible notes and so on, you have to actually take actions to get hold of that to then use it to write off losses. And so your Tier 2 capital is certainly, while it's there to absorb losses if you need to get to this stuff, it's often quite hard to get to it. It takes time to, particularly the convertible notes, you have to actually come up to a conversion and convert them from debt, which is a note, into equity to be able to use that stuff. So the Tier 2 capital is certainly a lower quality capital. And then that essentially brings us to this point here. This is where we were. Let me see, shift some of this stuff. So one of the things that's happened over time, and we talked about this in the previous section, is that what has come in, at first informally and then formally in the Basel II, was the risk weighting of the assets that you have on your balance sheet. And so at least initially when they started doing risk weighting, it was an informal agreement between the regulator and the banks themselves about, and to allow them to estimate how much risk they have with the assets they had, and then from that they would calculate how much capital they would have to hold. And then those things which had been informal were formalized in the Basel II agreement, and the risk weightings categories came out, and then most of the other banks, not the major ones, but all the other ones went on to risk weighting at that point. And we've said before that this weakened the banks by reducing the amount of capital that they held. And here's an example. This is essentially what was happening in that period. And so if we think that here's about where Basel II came in, okay? If we go before that, essentially what was happening is the regulators were allowing the very large banks to do their own assessment of the risks that they had on their balance sheet, and then from that they would then be able to calculate themselves how much capital they should hold. And this blue line here, as you can see it heading downhill, this scale here is the risk-weighted assets as a percentage of the total assets. So if we go back here, the earliest data point they have is 1993. It's about 70% after risk weighting. But what they have done over time is that they have estimated that the riskiness of their assets goes on down, until we hit the crisis period and a little uptick there. And if you ask yourself, did they really hold less risky assets, or is this just smoke and mirrors? This is basically them making their own assessment of their risk, and by lowering the amount of assets they had after risk weighting, they were able to hold less capital, and of course that tended to weaken them as time went on. Now this particular graph is for the 17 largest global banks, but at 2004, when this was put into Basel II formally, then basically all other banks went onto risk weighting, and of course that made their balance sheet look apparently smaller, and it reduced the amount of capital that they held, and that reduced their apparent strength, well, their actual strength. And if we looked at this one before. I'll show it again because it does show you quite clearly what happens to the size of your balance sheet once you're risk weighting. Here's the ANZ as at the end of last year. It had a total exposure to default of just over $77 billion. That's total. After they risk weighted, it's down to about $74.5 billion. So it's a nearly 60% reduction in the size of the apparent size of the balance sheet after risk weighting. And of course, that is the number you then use to calculate your capital adequacy. You use the thing after risk weighting, not the one before risk weighting. So what has happened, of course, is that, it still goes on, is a lot of Basel III, part of the Basel III agreement, that was trying to fix a lot of the problems that they created in Basel II by allowing this to take place, because this definitely weakened banks as time went on. Now, I got one other thing. Yeah, one other thing I should show at this point. This one again, I've shown it to you before, but there's an interesting question in here that we should probably look at. So this is the New Zealand banks here, again taken as a group, although we have the 5 largest ones, ANZ, ASB, and so on, down here. And what we see when we look at their requirements, here's the regulatory minimum is along here. It stepped up in 2013 and it stepped up again in 2014 and is now at 8.25% for your Tier 1 capital. But the blue line here is the Tier 1 capital ratio up as the banks, and you can see it's well above the regulatory minimums. Average New Zealand bank is around 12%, and if we grab, where's my ANZ one? I'm going to grab ANZ. Here's ANZ. This is taking, if you look at them at the end of last year, total capital was 14.3%. And of course, that is against their risk weighting, not their unrisk weighted stuff. So the New Zealand banks and the Australian banks are holding a lot more capital than the regulators say is necessary. So this is the question. Why did they do this? Because if you think, what's the argument for holding less and less capital? It's quite simple that if you hold less capital, basically that means you can make more loans. And of course, make more loans, you got a differential there in your interest rate, and you make more profit. So when someone looks at this, they say, well, these banks have too much capital. They should either pay it back to their shareholders as a special dividend, or they should go out and make some loans and drop this ratio down. So what's the benefit? Or maybe say, why would the banks, our banks do this? Why would the Australian banks do this when there's no requirement to do this? Yeah, you got an idea?
I reckon that it's just because, as you mentioned before, that the APRA that would not allow them to the shareholder hold more than 15% of the voting rights, so that they cannot, even though they can have returning earnings within the company, but they cannot repurchase the shares.
Okay, so that's an interesting point. I hadn't thought of that one. It's quite a good point, is that if you think back to the previous section, the APRA has this restriction that no one shareholder can hold more than 15% of the capital, 15% of shares on issue in a particular bank, and that's to try to avoid them pressuring the bank to run the bank in a way that's beneficial to that particular shareholder at the detriment of others. So the fact that you haven't got big chunks of activist shareholders out there, you don't have a pressure from your shareholders in that sense to have lower capital ratios. That's an interesting point. Okay, that's a good point. Any other reasons why they might do this? Yeah, go ahead.
So, like, maybe even if it is bad times and they do incur more losses, they still wouldn't reap.
Okay, so they could be socking away capital for hard times. That would certainly be a very good argument for doing this. If I mean, even in the world today, even though we're 7, 8, 9 years past that crisis period, the world is still pretty precarious in terms of the economy. A lot of parts of the world are not doing well, and so socking away more capital for hard times is probably a wise idea. In terms of the risk weighting of other things, I did talk to a guy at ANZ once, probably 3 or 4 years ago, about this issue, because some people then, the shareholders, were saying that they carry too much capital, and either if they don't have a good use for it, should pay it back, or they should, if they do have good use for it, they should put it to use and make more loans. What they said was, like, where's my other? You should grab this risk weighting lunch. Yeah. If you look at, say, for example, all this risk weighting that goes on, and here's a bunch of risk weights from the US for mortgages. And for mortgages, there's 8 different categories here with risk weights from 35 to 200%. These are regulatory minimums. Now, you as a bank can just take these as given, but there's no reason why you can't have bigger numbers in there if you assess the risk yourself as being higher. And when I talked to the guy from the ANZ, he said that their internal feeling as a bank was that these risk weights were simply too low, and so they had raised their risk weightings above the minimums that were required. And it's simply one of the things about something like this, this is just mortgages, and there's 8 different categories in there. What this tends to do, if you have a model like this, which is reasonably, well, not too complicated, but it's complicated enough, is that it gives you the impression that you understand the risks much better than you really do. And so because you have a complicated model, it tends to make you overconfident about what you're doing. And the ANZ, and they said the same thing was applied to all the other major banks, is that although these were the agreed numbers coming out of Basel III, imposed upon us by our local regulators, in their opinion here in this part of the world, that these risk weightings were simply not big enough, and they do their own calculations as to how much they are actually required. They do their own calculations about what they think they require, and that's why they end up like the ANZ does. In the ANZ, as the end of last year, after total capital was at 14.3, well above what is required, simply because they, as a bank, assess the risk as being higher than what the regulator does. Okay, any question on that? Before we move? Yeah, go ahead.
In this case, as you said, the banks just think that the rules from the regulators, they just kind of too low, so that they set up their own risk weighting.
Yeah.
So in this case, that regulation is redundant. So we could just rely on themselves, consider that they have exactly information that to assess the risks.
Yeah, in one sense, if you look at why you might have regulation, you have regulation to keep the bad guys in order. Where's my other graph here that I had? Can't spot it. The one where the thing went downhill. Got too many bits of paper. Yeah, when you look at this, this is major banks. One of the reasons you have regulations is because of the bad guys. Okay, and although if you think that the market should force self-imposed regulation, self-regulation, the market should impose sort of market discipline on them. If that actually works, then in one sense you don't need regulation. But this happened. This decline happened because of strong pressure from shareholders to make that happen. And so the regulations are there is basically to keep the bad guys in order. Now the good guys, like the banks who hold a lot of capital, there's nothing to say that they won't turn into bad guys in the future. But currently, if you look at how much they hold, the regulators have really got nothing to do because they themselves are assessing this risk as being higher than the bare minimums. So, yeah, reasonable point. Yeah, go ahead.
Do banks in other countries have lower promotions?
Yeah, unfortunately, like if you look at that, the red the red line really does tell you another nasty story about this. So this is the leverage ratio. So what this is this is the ratio of assets to equity. Okay? So that's a simple assets to equity, no risk weighting. And if you start back here, they are at about 20%, which tells you, well, that's actually 20%, 20, it's not 20%, is that for every dollar of equity, they had about $20 worth of assets. By this time here, they were above 30, maybe around $31 worth of assets for every $1 equity. And so this gives you about a 5% ratio of equity to assets, and this one is almost down to 3. And so what was happening, you can see there, and that the major banks were doing it, and when Basel II kicked in, almost all banks that went on to Basel II had a reduction in the amount of capital they held. So that was because of the risk weighting. Okay, does that answer your question? Sort of.
So what's the red line again?
It's the leverage ratio. So here it is at 20 back here. So what that means is basically for every dollar of equity you hold, that's not capital, but every dollar of equity, they have $20 of assets. Whereas what happened when it went up, you can see it climbing up, and up here it's probably around $31, $32 of assets for every dollar of equity that you hold. So if you take a simple ratio of equity on the top and assets in the bottom, don't do any risk weighting, just equity versus assets, you're at about 5% here. You're almost down to 3% there.
So that red line means that it's the actual bank's capital structure, isn't it?
Yes, yes, yeah. So this is what it looks like after they do the risk weighting, but this is the simple ratio of equity divided by assets, which is actually the better measure in terms of whether the bank is going to fail or not. Okay. And the last, I mean, really, as a bank, you shouldn't be running your bank in a way that will die if you hit problems. But you just shouldn't be doing that. And what we know, even though this argument is made that if you hold too much capital, you will not make so much profit. What we know in practice is that the banks that tend to hold more capital, voluntarily hold more capital, over the long run are also more profitable than those that hold lower levels of capital. And you think, why is that? Because the argument, the technical argument is that it should be the other way around. And my suspicion, and I don't know if this is true or not, my suspicion is that good bank managers hold more capital, but because they're good bank managers, they also end up doing better business, being more profitable than people who take excessive risks and then get bitten with it. Yeah, another question?
Yeah. Is it possible that for them, consider that from the last picture you said that they hold more capital than they needed to?
Yeah.
Is it possible that they think that this is a capital structure is optimal, they think?
Possibly, yeah, they possibly might think it's possible. Now, there has been work done by several central banks, our one included, because there are while everybody from the banking side and the shareholder side argues about the costs of holding capital, there are benefits to holding it. And what they've tried to do is do this cost-benefit analysis and try to work out what's the best place, where's the best place to be in this capital structure. And the estimate is, and it just is an estimate, that the cost-benefit flattens off to zero at around 16%. And so when you think of the ANZ up around 14.3, they're pretty close to what several central banks, including our own, think is the best point in terms of the cost-benefit analysis. So it's probably if you think in terms of optimal capital structure, yeah, they're probably making that decision. Okay. Anything else? Right. Okay. So we'll move along. So one of the other things that happened between Basel II was at 4% for your tier 1 capital. That's your good quality stuff. I mean, that's really low, particularly once you've been risk weighting things down. In fact, when you actually look at equity to total assets in some of the British banks, they were under 2% heading into the crisis. And, even after risk weighting, they didn't have to have lots. And that was up to 6% in Basel III. Now, I've talked about most of these phasing in. This one's already in. This one they brought in, I think, 2014. And this countercyclical buffer is still coming. Okay. Any further questions on capital adequacy before we go to managing credit risk? Okay, so here's a question. It says, explain why the credit risk, and this is directly out of the book, explain why the credit risk associated with a loan portfolio is less than the sum of the credit risk associated with each of the loans in the portfolio. And of course, I put a little hint in there. Think about this. Is this really true? Okay, first off, let's say, what does this mean? Okay, what's this mean before we try to figure out whether it's true or not? What does it actually mean? Yeah, go ahead.
Would it be similar to like the shares thing where if you hold them together, it'd be like less risky than individually because it's like they're not perfectly correlated, so they offset each other a little bit?
Okay, so the basic argument is remember back to how we talked about diversification with respect to shares. The idea is if you hold a portfolio of shares, then that portfolio is less risky than any individual stock that you hold. And the basic idea is if you think about the stocks going up and down, the idea is if one goes down as your stocks you hold in your portfolio, another one will rise and offset it, and so you'll reduce the risk in total. That's the basic argument that's being made here. Okay. Is it actually true for this type of risk? Yeah, go ahead.
I think that there's a condition.
Condition, right?
You have to make sure the correlation has to be less than 1.
Okay, correlation has to be less than 1. Yep, okay. Yep, that's a good point. The correlation has to be less than 1. Did you have another point? No, that was it? I mean, that's true. That's true, yes. Okay.
But it was his little risk of losing money.
Yes, there's risk of losing money on a loan.
Gain money by it.
Not going to gain money.
Shares, like some go up and some go down.
Yeah, right. Yeah, you're onto it. Okay. I'd say, so, I mean, these guys, when they write these questions, I mean, a lot of them are quite good questions, but there's a few like this one where I don't think they think about this enough, because although the diversification argument works just fine in a stock market, it's because there's a potential to earn. If you think, here's the average, there is a potential for one stock to earn more than the average, and that offsets anything that earns less than the average. With this type of risk, you have basically two outcomes. One is, loan goes along like it should, you get all your payments as you should, no defaults, nothing, everything's fine. And you get what you expected to get. The other alternative is there's some sort of default along the way, late payments, stop payments, all the legal wrangle about getting the money back, all that sort of stuff, and you end up with less than you expect. And when you have this, if you think about a share, you have three possible outcomes. You do above average, you do below average, and this argument works fine in that situation. Where you have this one, either you do what you expect or you underperform. This doesn't give you any way to recoup losses via your portfolio by some other loan outperforming your expectations. I mean, they're never going to say, oh, you're such a good bank, I'll pay you more interest. That just doesn't happen. And so what happens when you look at this type of risk, there's a good reason for diversifying, but there is no way to earn more than you expected on a loan in this type of situation. And so I think my personal feeling is that, the question itself is actually wrong. Okay, any other questions or comments? Okay. Now, I got a slide, I think it's the next one, but I never know where to put. fact, it's a very odd place in the book as well. There's this system here. I probably won't say much about this, except to say that it's almost misleading in the book about what this is. In Australia, they have APRA, and they have their two systems for analyzing a bank. There's PAIRS, and then there's SOARS, which we talked about in the previous section. This is actually an American system for assessing their banks there. And even though the book discusses this and the various aspects of the bank, it's not actually in use here. In fact, if you look down here and see where its source is, Federal Deposit Insurance Corporation, that's the Manual of Exam Policies. This is a U.S. system, and that certainly is not clear within the textbook. But basically, when you look at what they're doing, they do exactly the same types of things that APRA does in Australia. Looks at their capital adequacy, looks at their assets, how risky they are and so on. Looking at the management, how they actually manage the bank, their earnings, liquidity, again, that's a core thing, and any sensitivity to market risk. That's pretty much what APRA does, except simply the categories are, APRA's got 12 categories. I think this is 6, is it? 1, 2, 3, 4, 6, yeah. 6 categories here, but they cover basically the same thing. So it is one of the mechanisms that's used for assessing banks, and this particular one is used in the U.S., which isn't very clear from the textbook. Okay, so when we look at a bank and the way it does its work, describe how internal credit risk ratings can be used to allocate funds to different types of loans. So what's an internal credit risk rating? What's that? Ooh, everybody's quiet. Okay. And then we'll look at why they have to consider a portfolio. So essentially, there's two parts to your credit risk that you have as a bank. One is every individual loan has its own credit risk. And so what a bank has to do is assess the credit risk of the loan. And often what they do to make this reasonably simple for themselves is that they actually put them into classifications like, a loan to a dairy farmer would be one type, whereas a loan to a business would be a different type. And so they look at their data and they assess in a statistical sense what's the probability of default for this type of loan, and that of course then feeds into their interest rate decision. So one of the things about that is if they're trying to figure out what's the optimal way to use the money that we have brought in terms of making the maximum amount of profit, just because you can charge a high interest rate on a loan doesn't necessarily mean it's highly profitable if that particular loan or that particular class of loans has a high default rate. So having these internal ratings, having these assessments of them, you can price the loans better, but also you can actually direct what money you do have into areas that are going to give you the greatest profit over time. Now, when we go to the second question here about considering its portfolio rather than individual loans, is that if you think, let's take an example of where it might have a problem. If you say you're a small bank and you only work in one geographical area, and let's take things that's actually not a bank, but it's a good example of this. In the Nelson area, if any of you are from that part of the world, there is the Nelson Building Society, and it simply operates in that small geographical area. And so when you're thinking about the loans that it's made, they're concentrated in a small geographical area. And if you compare that, say, to something like, one of the major banks, which has, loans spread across the entire range of New Zealand from top to bottom, the fact that you are concentrated in a small area gives you a higher risk than if your loans are spread out everywhere. And so something like a high concentration ratio, which is like what Nelson Building Society is, that means that your portfolio of loans is actually riskier than if that same group of loans was spread across the entire country. And so both dimensions, one is making a good loan to start with, assessing that risk on that individual loan and managing that risk on that loan as you go through the life of the loan. They have to manage that, but they also have to manage them as a portfolio of loans and not as just a bunch of bits. And so in terms of the internal management of the bank, they've got to do both. So in terms of individual ones, it starts with the lending decision. When the person comes in, collect the data, and make a good decision at the start. Once you've made that, then you continue to monitor it, and the idea is to try to find a loan that's going bad before it starts to cost you a lot of money. And how much resources you have to do this simply depends on the size of the bank. Basically, bigger banks have more resources to do this. Often they have software systems that will do it, and then just pop up loans that things are in trouble for some human to deal with. But if you do run into a problem, next thing to do, if there's a problem, is to try to recover as much as you can once you find a loan that's gone bad on you. So your internal risk ratings. One of the key points here, remember we looked at the loan loss reserves in terms of the capital structure. Basically, this is money that you have put aside based on your estimates that will be used to write off losses. So this is statistically expected losses. And remember I think it was last time we talked about why this stuff goes in Tier 2, not in Tier 1. And you think of the economic purpose of capital is to absorb unexpected losses. This is money that has been statistically calculated as expected losses. And although it is capital, it goes in Tier 2 because you actually expect to use this stuff. Then the other things you can do profitability analysis on the types of loans, figure out which loans are the most profitable. Now, concentration loans, we just talked about that, like with the Nelson Building Society. They have a very concentrated loan portfolio that's geographically concentrated. Also, if you had particular concentration in particular loan types, like say, for example, if you're a credit union and you're making small consumer loans, you're concentrated in a particular type of loan, and that tends to drive up your risk. And in terms of that big crisis that we had, one of the things that caused the problem was that, and some people wonder why this actually happened at all, but people, it seems fairly genuine, it doesn't seem like they were fudging this, is that they did not expect the level of correlation between the loan losses that occurred. And basically, if you think about, say you have a group of loans, and this one goes bad, okay, so here's your line of loans, this one goes bad, the assumption was that it was not entirely independent of the other ones, but there wasn't a strong correlation. And yet, if you think about the concentration ratio problem, about why that is a problem, is that, let's say, for example, you take Nelson Building Society, concentrated in a small geographical area, say there is some major problem there, like they get hit with a big earthquake too. And suddenly, loans will go bad, and they're not independent. They're strongly correlated with you. Like, for example, if you had, as happens in some areas, a major employer goes under, then the losses are there, the defaults, they're not uncorrelated. They're all correlated together. And so that should affect, it didn't affect, but it should affect the level of risk you think you're taking. And of course, that feeds into both the interest rate you charge, but also feeds into how much capital you think you should hold. Okay, any question on that before we go on to interest rate risk? Okay, so it's still 25 to 4. What's the real time? How's the time going? 22, so we've got 10 more minutes. Right. Okay, so we're moving on to interest rate risk. Right. So here's normal business practice as far as the bank is concerned. Usual business practice is that they borrow funds short term and they lend long term. And although I showed this before, I'll show it again so we can sort of at least refresh our minds about how much short term they have. This graph here is basically the maturity of the type of bank funding. So this is basically the money they borrowed. The blue here is stuff that has a maturity of less than 1 year. The red, which is not very much, is stuff that has maturity between 1 and 3 years. The green is 5 years and over, and the black, which you can probably can't even see, that's 3 to 5 years. So when you're looking at that, thinking, where do they get the money from? The vast majority of the money they have is short-term money. But when you go look at the other side of the balance sheet and look at their loans, they're long-term. So what's the problem? What is the problem of the usual bank practice of borrowing short-term or lending long-term? Yeah.
I think it's about the liability and the asset. The maturity of those two are not the same. So so that the interest rate risk is going to affect quite a lot of other,
Okay.
like the duration.
Okay. So the duration, will come to the duration analysis soon. But basically, if it's short-term, we know that the interest rate risk you face on short-term is significantly less than you face on long-term. And so when you think, these two things are on opposite sides of your balance sheet, you have low interest rate risk on your liability side. You have high interest rate risk on your asset side. That's the basic problem that you've got to manage as a bank. So here's this horrible example. This is in the book, but when you look at their table, it's hard to figure out what on earth's going on there. So what I'll do is I'll just sort of go through this table and try to explain this to you. Hopefully once you've seen how it works, you'll get the idea. So the idea, if you go back one here, is that they're going to make this one-year loan, and it's going to get 9%, and it's one of these loans that there's no payments along the way. You simply make the loan, and 1 year later, they pay everything back. But how you're going to fund it is half of it you're going to fund with a 3 months, basically term deposit, and the other by a 6-month term deposit. So you start off with a 5% interest rate on that one, a 6% on that one, and a 9% on that one. And you can see, of course, you make some money off that because your cost of funds is lower than what you're getting from your loan. So this is basically how it works. At time zero, you bring in 2 lots of $500. That's those 2 term deposits. There's your interest rate, 5 and 6%, just below them. And so you have $1,000 coming in, which then you turn around and you make out as a loan. So that's going out to the person who's borrowed it, and you're going to earn 9% on that, but you don't get that 9% until the year is over. Now, after 3 months, so here we're at this point here, is you have to pay off the 3-month one. That should be 3. This should not 6. That's actually a mistake. So if you think about what they've got to do there, they've rounded these to full dollars. It should be $502 and 500 whatever. Is they're going to pay that off? So they've got to pay off this one here. Actually, that number's not right. Oh, well, don't worry about it. We'll say it's right. Okay, so this is the one they pay off, okay, because that was only a 3-month term deposit. And of course, they have to replace that money. And so what they do is they issue another one here, $506, again at 5%. And so we go into the next time period. So they've replaced that money. They paid the other person their interest. They've gone away. They got a new one. And then at 6 months, okay, what happens is that you have to pay off. This one here has to be paid off, okay, because it was only a 3-month one. And the 6-month one also has to be paid off. And so you pay that person the $515. So you have a total outflow there in that case of $1,028. That's to pay off those 2 term deposits. And of course, because the loan has not matured, you have to bring in, again, $513. This is for the 3-month one, and $515 at 6 months to keep this loan funded. So it goes along another 3 months. We're now at 9 months. And of course, this one now has to be paid off. And that gets paid off there, $519. And because the loan has not matured, you have to pull in another $519 from some other deposit, again at 5%, to continue to fund this loan. And then at the end, the person pays that loan off. And so they pay you $1,090, okay? That's their $1,000 they borrowed plus the 9% interest. So that comes in now. And then you make the two payments. One is this one here now has to be repaid. That costs you $525. And this one here, this one here is paid off, and it costs you, as a bank, $530. And so your net outflow there is $1,055, which leaves you a gross profit of $35 on that loan. So that's things if the interest rates don't change. But this is basically how I do it. Borrow short term, then long term, and you get some money on the interest rate differential. Now the problem is if the interest rate changes. And the interest rates can go up or it can go down. If they go down, it's good for you. If they go up, which is what we'll consider, then it's bad for you. So what happens when we go to the next one is when the interest rate goes up. So it starts here at 5 and 6%, and then the interest rate goes up. So what's really different here is in the previous one, that was at 5% because the interest rates have not changed. Now the interest rate's gone up, and they're having to pay 6% on this money. And again, this one also goes up. So when it comes time to roll over that 6-month one, the interest rate has gone from 6%, where it was at the start, to 7%. And of course, that means that your cost of funds is rising. Now, in this particular case, when it comes out to the end, you still get your $1,090 because that's what it's contracted. And you actually pay out a total of $1,062, and your margins got squeezed. Okay, was $35 gross margin on that in the previous case where the interest rate didn't change. But in this case, as the interest rate rose, your gross margin got squeezed and you're only getting $28. Now, if it goes too far, this can become negative. But this is the basic risks that they're going to have to manage. Is if it went the other way, okay, interest rate drops, they actually make more money than they expected. So there's two sides to it. Interest rate drops. It's good for them because they get their funding cheaper. If interest rates rise, funding costs rise, and their expected profit drops. Okay, any question on that? Okay, makes sense? No? How's my time going? What's that? 1 minute. Okay. Right. Okay, so we'll pick it up at this point on Friday, and hopefully we'll finish this off on Friday. So if you want to ask any questions, I'll be around for a while. Otherwise, hopefully we'll get this done next time.